Okay everyone, today is February 25th, 2026. We're back on the channel again tonight. The performance of the three major indexes today was very much in line with expectations, even better than expected. Before the market opened, there was strong anticipation around NVIDIA's earnings, and some defensive buying took place. Wall Street was generally forecasting an EPS of a 152. After the bell, we now know the results massively beat expectations. Revenue came in at $68.1 billion. The forward guidance was explosive. As you all know, NVIDIA's new architecture is coming this year, the next generation Rubin architecture. In the earnings guidance, NVIDIA also addressed several key market concerns, including its partnership with OpenAI. There were previous rumors that the two sides had fallen out, but Jensen Huang personally responded to those claims. At the same time, customer orders across the board were very strong. Under this kind of guidance, it made sense for investors to initiate some defensive buying. Across the broader tech sector, including what we discussed yesterday, Anthropic announcing its new tool suite, some of the market's concerns were eased. The so-called doomsday narrative for the software services sector cooled off a bit, and overall sentiment seemed to stabilize. However, in my view, we shouldn't blindly listen to analysts every day. Their buy actions and public statements ultimately serve their own portfolios and hedging strategies. If you're trading short-term and following sentiment, that's fine. You can treat these developments as event-driven anchors for trading. But if you're investing long-term or building a long-term portfolio, then you need to evaluate these developments independently. I've repeatedly reminded everyone, software stocks, especially software services, will inevitably be replaced by AI. They will be replaced by AI agents. That's not even a question. Fundamentally, there isn't much else today. The main driver was still NVIDIA's earnings, which gave the market a strong boost. Even after hours, everyone was still focused on this. Overall, whether it's US equities or crypto, we saw a solid rebound. Yesterday, some viewers mentioned that our analysis timeframe was too large and not very meaningful for short-term trading, since I usually trade based on daily or even weekly charts. So today we'll narrow the timeframe. Let's look at the 4-hour chart. On the 4-hour level, as we've discussed before, when this kind of box pattern forms, especially at higher levels, it's important. This is Nasdaq. For the S&P, this box at the highs is essentially a rising flag pattern and a very clean one. The slight difference is that the Dow may have formed a top and briefly broke above the box. It spiked above 50,000 and then returned to the range, but we'll ignore that temporary breakout. Previously, we taught a very simple method. Even if you don't understand technical analysis or market analysis, when you see this kind of core trading range, or what we call a trading center, you simply draw a box around it. After drawing the box, use a horizontal line to divide it into two parts. Or you can divide it into three by drawing two lines. 1, 2, 3. The range I'm drawing here is just approximate. You can calculate it precisely and split it into equal thirds or halves. If you divide it into three equal parts, then the lower zone is the weak zone, the upper zone is the strong zone, and the middle is the neutral zone. In this setup, you can clearly see where the market is positioned during this consolidation. What's the trading significance? If price is in the weak zone, you definitely should not go long. Some people ask whether they should trade a bounce since it's still within a box, but you don't know how long the box will continue. So the weak zone only tells you the market is weak. If price moves from the weak zone back into the neutral zone, that shift itself signals the market may be warming up. And that's when you can consider going long. If price moves from the strong zone back into the neutral zone, that shift tells you the market is weakening, and you can consider going short. So the absolute position isn't the most important part. The transition process is what matters. I don't know if everyone understands this point. If you do understand, let's look at the Nasdaq now. It has moved from the weak zone into the neutral zone, and it did so in a very strong way. Even with a gap up, it's now attempting to attack the strong zone. What does that mean? It means the market is shifting from weak to strong within this consolidation range. This kind of rotation inside a box is very common. The trading opportunity here is actually quite good. If price can enter the strong zone, it will definitely challenge the top of the box. Whether it can break through is another question. In my view, it's difficult because the recent highs have been gradually declining. The highs are coming down, so it won't be easy, but it will attempt to test the top of the box. That gives us a long opportunity. For those trading ETFs, you can use this method to observe the market. It's a very simple approach. As for today's reaction across the three major indexes, it was largely within expectations. We've mentioned before, this box was drawn a long time ago. It's not easy to break down below it, and it's not easy to break above it either. If it breaks down, you can go short. We previously said that when it broke toward the 50,000 area, that was actually a very good short entry point. This kind of structure tends to persist for a long time. It can continue consolidating here for quite a while. As for whether it eventually breaks upward or downward, we don't know. What we do know is that it is currently continuing within this range. So what do you do when you don't know what to do? When you're uncertain, you look at fundamentals. You need to form your own understanding of the overall industry environment, the macroeconomic backdrop, and even the geopolitical landscape. As for the Dow Jones, I'll summarize it in one sentence. The US economy remains highly resilient and strong. We can see that today from indicators such as consumer confidence. The US economy is still very resilient. So regarding the Dow, if there are suitable opportunities, you can choose selectively. Personally, I'm not currently selecting traditional stocks. It doesn't fully align with my investment philosophy. But in the future, I will pick some and share them with everyone. For now, the Dow remains firmly within a strong zone. That's the conclusion for the Dow. That's all I'll share about the market for today. Today, I want to share a few individual stocks. First is Circle. For those familiar with the crypto market, you should know that the two dominant stablecoins right now are USDT and USDC. USDC is issued by Circle. Why am I recommending a stablecoin related stock instead of something like MicroStrategy, which is heavily leveraged to Bitcoin, or a company like the one associated with Tom Lee that focuses on Ethereum? Because in the future economic loop of AI agents, stablecoins will be a crucial component. Think about it. When AI agents transact with each other, will they use Bitcoin? Will they use Ethereum? Will they use Dogecoin? Most likely not. They will probably use a currency with broader consensus and lower volatility for small payments and transactions. So Circle becomes relevant. Of course, USDT would be even more direct, but USDT's parent company Tether is not publicly listed. Circle is. And its earnings were also very strong. After today's earnings release, the stock gapped up. Looking ahead from a technical perspective, price has returned to a previous upstream range. The prior core trading zone was around this area. In theory, after a complete downtrend finishes, price often rapidly returns to the previous discussion or trading range. Here there was a trading center, and here as well. The earlier high doesn't count. That was part of the bull market top. During the decline, we had one trading center here and another here. Now, driven by earnings guidance, price has quickly returned to the previous trading center. This is a leading signal of a potential bottom. We cannot say it has definitively bottomed, but it is a precursor signal, and it's an important one. If you understand basic technical analysis principles, you can interpret this as a transition from bearish to neutral, similar to what we discussed earlier, moving from a weak zone into a neutral zone in an offensive manner. This transition phase must be monitored closely. From a fundamental standpoint, as I've mentioned before, AI agents will inevitably form their own economic system. That's our baseline assumption. AI to AI transactions are different from human transactions. Humans can use credit cards, PayPal, or cash. But AI agents may only have one or two standardized settlement options between them. Of course, we are talking about the period before full AGI. With current AI systems, they still purchase services provided by human companies, enterprises, and websites. So most payments are still tied to US dollars. In that sense, dollar-based stablecoins are arguably the most practical payment infrastructure. Stablecoins are not just for crypto trading. In the future, they could become the money inside AI wallets. AI wallets won't hold paper currency. Most likely, they will hold stablecoins. So this is something worth paying attention to. That's it for today's stock ideas and market analysis. The market remains in a high-level consolidation within a strong structure. If there are specific topics you'd like covered, leave a comment and we can incorporate them into future episodes. Hit subscribe and see you tomorrow.